I want to welcome everybody to today's webinar. We're happy to have Matt Allen, who is the Vice President of Portfolio Lending for North American Savings Bank. He's going to discuss leveraging your IRA. Thanks, Matt, for joining us.
Thanks, Jamie. Appreciate the invitation to present a webinar to you and your clients. I think it's always important to educate, and this is a great way for individuals that are interested in self-directed accounts learn how they can leverage the purchase of real estate within that truly self-directed IRA. So as Jamie mentioned, my name is Matt Allen. I'm with North American Savings Bank, and we're based out of Kansas City, Missouri. And today I just want to give an overview of how you can purchase real estate and then also use an extra component that most people are unaware of, and that's leveraging the purchase with a non-recourse loan. And we'll go into more details about what that entails and what the differences are and how you can really maximize your profits within that self-directed account. So the first thing, and this might be a little refresher for a lot of you that already have self-directed IRAs or self-directed 401ks, but just want to start the presentation with a reminder that, setting up a self-directed IRA, very easy and simple. You basically can start a new account, or I guess make a contribution to a new self-directed IRA with Next Generation, or you could roll over funds from a 401k plan, 403b, defined benefit plan. There's numerous ways how you can start this investment process. And so once you do that, the IRS is kind enough to allow us to purchase anything within a self-directed account except for life insurance and collectibles. So if you think about that, that really opens up your options. Most popular, or at least one of the top 2 or 3, is real estate, which includes single-family, commercial, raw land, apartment buildings, and then some other popular options are tax liens, mortgage notes, starting a company, starting a business, a bank, and then also stocks, bonds, and mutual funds. But that's really a traditional investment that you can purchase with any brokerage, and don't need that self-directed institution to help you with that. So again, lots of options, but today we're only going to focus on real estate, primarily residential real estate. So again, another recap of the benefits of self-direction. Allows you to diversify. So if in 2008, 2009, you really got stung by the stock market, and that was an eye-opener for you, and realized I need to diversify my accounts. I don't want everything heavy in equities, bonds. So you've looked at real estate, and that pops out as something that maybe your real estate agent, or you're more familiar or comfortable with real estate, and you like that tangible asset. Well, this allows you to do so. You can actually choose and control the deal. So you have more options. You can actually go visit the property, do your due diligence up front, and maybe have more of a comfort level. And then you can increase your buying power because you're able to leverage that purchase. So it's definitely an added benefit, where if you're purchasing stocks, you typically don't have the opportunity to leverage the purchase of stocks, bonds, mutual funds, where with real estate you can do that. And then opportunity to earn a higher return if you know that there's some really good opportunities with some foreclosures, short sales within your local community, or other markets around the country. Instead of earning 7-8%, maybe you could increase that to 12, 14, 15% with the right investment and choices you make. So there are some important rules to remember when you buy real estate within an IRA. It has to be for investment purposes only. So you can't live in that property even for 2 weeks out of the year. So if you wanted to buy a condo in Florida, and then a couple of months in January you wanted to visit it, unfortunately that's something you should be doing, or you could face tax consequences. You can't live it in, as I mentioned, or you can't rent it out to certain family members. So basically, to simplify it, up and down in your family tree. So ascendants and descendants, your parents, grandparents, children, grandchildren, your spouse, yourself, they can't be tenants, or yourself. And then all improvements and repairs must come from that retirement plan. So you can't dip into your personal pocket to fix that leaky faucet or improve the roof. It does have to come from funds that are already established with the account that's on title. So That's an important factor to remember, that you also want to have some reserves in the account in case some emergency does come up, because in a lot of cases they typically do, and you want to be prepared for that. So there's really three ways to purchase real estate within a self-directed account. Purchase outright. So if you're buying a $100,000 home, you have $100,000 in your self-directed IRA. At the closing, $100,000 would go towards that purchase on the closing statement. Then you would own that asset. 123 Main Street, Kansas City, Missouri. You would be able to see that with your statement with the next generation. Pretty simple. You know, it's cash-only transaction. There's no loan involved. It allows you to purchase a property, you know, within 3 or 4 days if it comes to it. If the seller's motivated, that's the advantage of a cash transaction. Partner with another investor. So this too could be a cash transaction, but with that $100,000 scenario, maybe you only have $50,000 in your account, but you really think this single-family home is a good investment. So you talk to other investors in the community, you find that right investor. They're willing to put down $50,000 also, and it may be another IRA or it may be an individual, but there's, you know, a multitude of options for that. And so then you both put $50,000 down on at the closing statement, and then you would own that property, or 50% of that property would be held within your self-directed account. And then the third option, that's what we're going to focus on primarily, is using leverage. So that $100,000 scenario, maybe you're just not comfortable owning real estate with another investor. You'd rather own it yourself, manage it yourself, don't have the extra complexities that go along with that. So you have $50,000 again in your account. You get a loan for $50,000, a non-recourse loan. You're still putting that $50,000 down from your IRA, but that leveraging that purchase allows you to purchase a single-family home without the use of another partner. And you know, as you build up that account, it possibly could allow you to purchase another piece of real estate. So as I mentioned, the partnering option, which we see frequently, you can partner with yourself, your spouse, other family members. Sometimes individuals create LLCs in which the self-directed account invests as a member of that LLC, and then title is held within the LLC account, or other IRAs. As I mentioned, it could be next generation, 2 or 3 next generation IRAs are on title. You could have a third ownership for each. There's really no limit as to the number of accounts that are on title. I will say, over the years, as we've closed a lot of these transactions, the more I have, I guess the more involvement there is, as far as if you have a leaky faucet, as I mentioned, and there's 25% ownership for 4 different IRAs, well, to pay that plumber, 25% of the payment has to come out of each IRA account. So sometimes that can add an extra layer to it. Again, not to deter you from doing that, but there's some things to think about. A couple scenarios here. I want to go over a typical rehab situation that we've seen, and we don't get involved with rehab transactions, but just to give you an idea that there's really 2 ways you can buy and purchase real estate with an account, a self-directed account. So in this case, the individual has $500,000 in their IRA. The purchase price is $300,000. So they acquire that property. They put $140,000 in rehab expenses to it, and then they end up turning around and selling that for an $85,000 return. So as you can see, that's a very good investment, something that a lot of investors are doing nationwide. So again, a cash transaction, buying it, improving it, basically a flip, earn their profits, go on to the next transaction, the next deal they can find. Second one is a rental investment property. So this would be a long-term hold, and that's where we get involved, where we're looking for individuals that are looking to hold these for cash flow on a long-term basis. So same situation, $500,000 in the IRA. Due to leverage, they're able to purchase 2 rental properties. They're putting $500,000 down, and the remainder they're getting a non-recourse loan for. So they can rent that property. They're going to be able to grow that positive cash flow, either tax-free or tax-deferred, depending on if it's a traditional or Roth IRA. And then also they're going to get the benefit of the appreciation of it. So when that does, 5 years, 7 years down the road, they decide they want to sell the property, that profit proceeds will go back into that account and also have that same tax benefit. So that's the real beauty of self-directing with investment property. Just like any other asset, but sometimes you can get a greater return, and also the diversification that we mentioned earlier. So the rest of the presentation, I will focus on the non-recourse loans and what it really involves, and what you should look for, what you should know up front before you're making that offer. So, what are the advantages of debt financing? How do you get a non-recourse loan? And then what kind of guidelines and parameters are you going to look for from a bank? In North American Savings Bank, we are one of the few banks that offer this type of transaction. And I'll speak more general terms in this presentation, knowing that you're probably going to have, I would say, 2 or 3 options nationwide, and we are one of those options. So you don't have enough money in your self-directed account. What can you do? Non-recourse loan is going to be that option. And a non-recourse loan is one in which you, the account holder, aren't personally liable for the repayment of the loan. So if that loan ever goes into default or foreclosure, the lender cannot go after the IRA account holder or the IRA account holder's assets within that self-directed account. So the only collateral is the property itself. So 100% of that, I should say, is the collateral. So that's an extra benefit for the borrower, that they know that they are secure in the sense that their other assets won't be tapped into. And a lot of states are non-recourse states, California, some others, but this is not typical. And a non-recourse loan, the reason why that we, for self-directed accounts, why they're required is the IRS in Publication 590 says that you can't use your IRA as security for a loan. Well, that only leaves one option. And again, most banks don't offer this type of loan. So you walk down the street to Wells Fargo, Chase, Citi, and you mention a non-recourse loan for IRA, they're either going to look at you really puzzled, or they're just going to tell you flat out that we don't offer that type of transaction. And it's something, over the years, I know some of them have been introduced to it, but they just don't feel that it's something they want to get involved with. So North American Savings Bank is more of a mid-sized bank, and it's a good product for us since we have to hold these loans 100% in our own portfolio. We're not selling these in the secondary market to other investors. Again, North American Savings Bank, we're founded in 1927. We're publicly traded, mid-sized bank. We have deposit branches in Kansas City, Missouri. And we launched this program back in 2005 when we were working with one of our deposit branch customers here in Kansas City, just to give you a little insight how we got involved. And we wanted to purchase 2 duplexes here in Kansas City, and he only had enough for 50% down. And he was told by his IRA custodian that he had to get a non-recourse loan. So we looked into this, did a little more research, talked to his custodian, realized that the risk for us was limited due to the fact that he's putting 50% down. So we ended up closing those 2 transactions, and then we spent the next 6 months really researching this, and then we officially launched this program. And it's been a great a product for us, and something that has grown over the years, evolved, and each year we see more and more investors kind of have that aha moment that, oh, I didn't realize I could buy real estate in an IRA, and then secondly, I didn't know you could actually get a loan to do that. So it's been the last 10, 11 years, something that has really opened up real estate investing for self-directed account holders. So again, the advantages, all your net proceeds go back in that IRA tax-free. Leveraging allows for larger gains. We see so many investors buy multiple pieces of real estate instead of just limiting it to one, and that's something that we even have some customers that have purchased 4 or 5 homes. They may hold them for 3 or 4 years, sell them, and then come back for us another loan on another investment they may have found in their market. So the minimum down payment requirements for this type of transaction is a minimum of 30%. Typically, I would say around 40% is more the norm, and that's depending on the type of property that you're looking to purchase. Single-family homes, I would say that's kind of our bread and butter. 70-75% of the transactions we lend on are single-family homes. Minimum down is 30% for those. 2 to 4 units, condos, and multifamilies, and we typically cap that around 8 to 10 units. So if you're looking for that large 50-unit apartment complex, that wouldn't be a fit for us, but you may be able to find some commercial lenders out there that would be open to a non-recourse transaction to a self-directed account. But again, 30 to 40% down, so that does come out of your retirement plan, and you still want to have enough for reserves, as I mentioned. Now this would be considered multifamily, since 100% of the collateral lies within that piece of real estate. That's a very important ingredient for us, and why I show this picture is that we're going to get an appraisal on every transaction. So we want to make sure that the piece of real estate that you're purchasing is in livable, rentable condition. One, we don't want you to have to take a property back, or I guess have property go into foreclosure, and one, we're not in the business of selling real estate. So a full appraisal is required. We order rent comps with each transaction, really good understanding of what the property is worth, and again, it's an added value for both you and the lending institution. So the difference when you're buying real estate in a retirement plan versus your personal name, you want to make that offer on the purchase contract as Next Generation TS LLC, FBO, your name, IRA. Now, if you were going to partner with another IRA account, say 50-50, it would still be Next Generation TS LLC, FBO, John Doe IRA, and undivided 50% interest, and then the same language, insert the other individual's name of 50% undivided interest. So that can be done multiple ways, but it's always best you make that offer in the name of the IRA. We've had individuals make it up front in their personal name and then want to assign that to the IRA account or make a revision to the contract, and that's typically frowned upon. So I would go into the transaction knowing that you're going to make that offer in the IRA account. We do lend in all 50 states, so we are a nationwide lender. We see a lot of in Texas, California, wherever the large population is, we're obviously lending there. But we do see investors looking to purchase in smaller markets around the country. Maybe they're just very familiar with the area and know that there's a college near the property, so it's always going to have positive cash flow. And this morning I actually read an article in the Wall Street Journal that mentioned rental vacancy rates are the lowest they've been in a decade at 6.8%, and rents are up in most markets, especially for single-family homes. So that's great news for single-family investors, and also just real estate investors in general, that if you're buying a piece of real estate now, very, very good chance you're going to have high occupancy rates, and that's really what everybody's looking for. They don't want that property to sit vacant for 2 or 3 months where you're losing money, and in this case, you still have to make the mortgage payment. So it's important that you do a lot of research. Make sure you talk to the realtors in the area, talk to other investors. What kind of cash flow you get? What kind of tenants do you usually see in this particular marketplace? What's the typical wait time between tenants? Do you typically see 60 days before you can acquire a new tenant, or is it usually within 3 to 5 days? So a lot of questions you should be asking, but again, that's a good sign that it's been the lowest in a decade at 6.8%. Processing time frame for a non-recourse loan. There's a couple of extra layers due to the fact that you're purchasing in your IRA. We usually advise 30 to 35 days from the date we order the appraisal. So you've made an offer, seller accepts, and you've set up the closing date for January 15th, which would be roughly 45 days out. Should be plenty of time, but we'll need a minimum of 30 days. And one reason for that is since you're making the offer in your IRA, not only do you have to read and approve all the closing documents, but Next Generation, has to sign off on the closing documents too. So that could be an extra 3 to 5 days depending on where all parties are located. If you're located in Kansas City, properties in Texas, Next Generation's in New Jersey, well, you can see the title company is going to have to receive the documents from the lender in Texas. They're going to have to send them to the borrower in Kansas City to read and prove, and then they're going to send them over to Next Generation on the East Coast in New Jersey for them to sign, and that's really the signature that's required since your IRA is purchasing the investment property. Then it goes back to the title company in Texas, and it's going to officially fund. So there can be that 3 or 4 day delay. So it's always advisable to prepare for that up front instead of adding it on the back end, and then sometimes you have an angry seller. So that's another piece of advice just want to throw out there. With the different type of loan programs, very similar to what you see on a conventional loan that you're buying in your personal name. We have a 5 and 10 year ARM, and then we offer a 10, 15, and 20 year fixed. Occasionally we'll offer a 25 year fixed. Principal and interest payments, minimum loan size is $50,000. So that puts your purchase price, minimum purchase price, in the low 70s. Anything less than that just doesn't work out as far as the down payment requirements we have. And again, we're looking for property that's rentable, livable condition. We're not looking for something that's distressed, needs extensive work. We want to go into it that you're going to start earning cash flow. And I will mention there are a couple other positives to this. Because your IRA is purchasing the real estate, it's going under the tax ID number of your custodian or your administrator and not your personal Social Security number. So these loans do not show up on your credit report. So if you have more than 4 loans on your credit reports, you realize that as you're a seasoned investor that it's sometimes a challenge to get loans with conforming rates because of that maximum 4 loans to receive the best rates available. So that doesn't apply with a non-recourse loan. You're never going to have lates. You know, we're always trying to avoid lates, but that would not show up in your credit report because, again, it's not going under your Social Security number. And as far as, I'm sure you're wondering what the current rates are right now, interest rates, we're typically right now we're in the mid 5s to the high 5s for a fixed product. So the 5-year ARM would be our lowest interest rate, and then as you progress to a longer amortization on 20-year, the rates would increase. And the reason we don't offer a 30-year fixed, amortization is we consider our friend. So, you know, the sooner you can pay down that loan, the less risk we have if we have to take that back and sell it in a foreclosure. And again, also, it's an added benefit for you. You're able to pay that loan off sooner. And what that means for you is that cash flow is going to become, I guess, an added more power for that IRA, because if you don't have a loan, then 100% of the cash flow is going to go back into the IRA. So we've never offered a 30-year fixed program, and I don't think that's something that we'll add anytime in the near future. When we've been talking about purchases so far with a non-recourse loan, there's also another option. So if you're on this call and you've already purchased real estate within your IRA, but you paid cash for it, let's say 5 years ago, got a good deal on it, it's appreciated, purchased it for 100, now maybe it's worth 150. You've eyeballed another single-family home that's 3 blocks away, think you can get a good deal on it, but you just don't have enough funds for an outright purchase transaction. You could take a cash-out refinance on that one you already own in your IRA, say $75,000 you wanted to put back into that account with the loan proceeds, so it would go back into the IRA. Then that cash you could use to purchase other assets, such as that other home, or you could also use those funds to improve your current property. So there's multiple options for you, but again, keep that in mind if you already own a home free and clear, or maybe you have a hard money loan, private lender, something that might have a high interest rate. That's something you could also pay off with a North American Savings Bank loan. Property eligibility. You know, residential homes are primarily what we focus on, single-family homes, warrantable condos, PUDs, townhomes, duplexes, fourplexes, 5 units. Commercial property, retail warehouses, and office buildings, we really limit that. We don't see a lot of inquiries on it, one. And then two, it does have to be the right fit. So if that's your niche, commercial property, we can definitely send you in the right direction of some other resources we've come across over the years that may be a better fit if you're looking to purchase a franchise restaurant or something in your retirement plan, and not actual residential homes. Ineligible property. So this is probably more important as far as what not to look for. And it's not that you can't buy it within your retirement plan. It's just getting a non-recourse loan is going to be extremely hard. The only options are going to be a hard money loan or a private lender. So raw land, think about it. You purchase say a single-family parcel. You're not earning any income off of that. So every month you would have to pay that mortgage, and you wouldn't have the cash flow to offset it, so it depletes that account. Farms, large acreage, hotel, condo hotel, something we typically steer away from. Storage units, timeshares, franchise restaurants or non-franchise restaurants. Those are things that, again, are going to be extremely hard to find a lender for. Cash transaction is probably your best option. We've hit on this already, but just to reiterate, you can purchase that home in an IRA, an LLC that has self-directed ownership, a solo 401k, a C corporation, partnerships. These are all things that we will lend to. As long as it's a self-directed account and within that particular entity it has a clause or provision that states real estate can be self-directed, we will lend to it. We're still going to do our due diligence on our end. So if you're purchasing with an LLC, we're going to require your LLC documents, look at them closely. We actually have an attorney that reviews all of them, make sure that you're setting yourself up correctly, and then we're also doing everything on our end to make sure that this is a kosher transaction. As far as income requirements for rental property, this is where we get into the cash flow aspect of it. So there's three things we're really looking for. One is the collateral. Is this property in a rentable, livable condition? Second thing is, do you have enough funds in that account for the down payment and reserves? And then the third thing is the cash flow. Do you have positive cash flow? And for single-family homes, we're looking for a 20-25% monthly positive cash flow. 2 to 4 units, we have that minimum of 25%. And I'm going to give you a couple examples here of how you can analyze it or how we analyze it. So when you're looking for that home, or maybe you need a pre-approval letter, you can come to us and you'll already have this information, and that will help speed up the process. So let's assume you find a $125,000 property in your community, make an offer on it, seller accepts. You've done your background research, $1,400 a month is the going market rent. So that's going to be a gross annual income of around $17,000 a year. So we're going to take out all the expenses associated with that, estimated expenses when we run our numbers. Vacancy, we use 7%, and as you can, as I mentioned earlier, the current nationwide rate is around 6.8%, so that's actually pretty accurate. Taxes, insurance, maintenance and repair, we estimate around $400 a year. You're going to have to fix that drywall, fix that leaky faucet, whatever it may be, and then a management fee factor. Most of the investors that we lend to do use a property manager, and 6%, that might be a little bit on the light side, maybe 8 to 10% is the norm, but we're going to analyze it from a 6% perspective. So you subtract out all those, around $11,000 is your net operating income. And on to the next slide, let's assume you put down $50,000 and you get a loan at 6%. So your annual principal and interest payment is around $5,800 a year. So when you take that net operating income and divide it by your annual P&I, it gives you a 1.88 DSCR. Now DSCR stands for debt service coverage ratio. So 1.00 is the break-even mark. So this property has excellent cash flow at 88%, which is not the norm. I'd say this is a little bit inflated. We're looking for something that 1.25 minimum range, but a lot of times we'll see in the 1.4 to 1.5 is pretty common. But again, this would be, from our perspective, we would look at this. This investment makes sense on your end, and it also makes sense for us. As long as that appraisal comes back, um, everything should be fine. We're going to order rent comps with the appraisal. So along with the value of the home, we're going to ask the appraiser to identify 3 rentals in the area to make sure that that $1,400 a month that you anticipate is truly there. If it's only $900, well, that really affects the numbers, and then we would reevaluate the situation. And if that puts your debt service below 1.0, maybe we're going to ask you to put more money down to help increase that, because the worst thing is we don't want you going into this investment knowing that you're going to have negative cash flow on a monthly basis. That doesn't suit well for the IRA account. Costs associated with this, just to give you an idea, and this is pretty norm across the board for the industry for non-recourse lenders, a 1% origination fee, underwriting, processing. I mentioned we do order an appraisal, $500 to $600. That includes rent comps. It's due at the time of application. And at the very beginning of the presentation, we mentioned escrow or all expenses have to come out of your account. So that includes your real estate taxes, your hazard insurance, everything has to come out of that IRA. So reserves are very, very important. We have a minimum of 10% of the loan size that has to be in your account at the time of funding, just to handle anything that may come up. So, we don't have very many accounts that are in default or foreclosure, a very small amount. And the ones, I will say, maybe 8-9 years ago, when the values really dropped and properties were purchased more on speculation and not for long-term holds, they didn't anticipate enough reserves in the account, and that's where they got themselves into some trouble. So definitely make sure you're comfortable with the amount of reserves you have in there. Also knowing that you can contribute $5,500, $6,500 a year based on your age on an annual basis, if you do fall a little bit short. Documentation, I won't go into this too much detail, but if you need a pre-approval letter, I would recommend that you call us directly. We can send you a one-page form. You fill it out on the property, and normally the same day, we will have our loan committee review your specific scenario and let you know if that would work based on the numbers that you anticipate. We're not asking for your income, your employment. That's simplified also, because since your IRA is buying the property, you're not qualifying for the loan. So it eliminates a lot of the red tape that you see in a property that's owned in your personal name. It really comes down to those 3 things I mentioned: the property, the cash flow, and then your IRA account. All of this can be found on IRAlending.com. We also have a book if it's something that you'd like to learn more about this, that we offer on our website too. Usually a good reference point, just kind of the nuts and bolts of non-recourse lending. And then also any questions, you can always call us at the number listed below. So thank you for your time listening to the presentation, and now I believe Jamie is going to come back on and take any questions that somebody might have.
Thanks, Matt. That was really informative. Does anybody have any questions for Matt? He did cover a lot of information. If you do have questions, you can type them in the chat box, and we'll address them. I did write down some questions before, but you answered all my questions, Matt. So. Yeah, it was really informative. I know that you had mentioned the approximately 30 to 35 days prior to anticipating closing. Is that, the whole application process plus, you guys doing all the appraisals and things like that? Is that all included in the 30 to 35 days?
Well, the 30 to 35 days, we base it off that the date we receive your application to order the appraisal. So if you've made an offer and they accepted it 2 weeks ago and we're not getting the application, it's 2 weeks in, we would still need 30 days from that date. And big reason now, the appraisers are extremely busy, and we've seen some backup in the last 2 or 3 months. And that might improve because rates overall have increased some, so applications are down. But certain markets, it can be 2 months to receive an appraisal back. So you really need to do your research there and make sure that what's the going turnaround time for an appraiser in your area. Colorado is extremely slow right now. Some of the West Coast states, But a good reference would be 35 days from the date we order the appraisal.
Okay, that's good to know. And I know that you had mentioned all of your fees have to come out of the self-directed account.
Mm-hmm.
And then how is the loan paid back? Do you require um, us as the administrator to send the payment to you guys on a monthly basis, or?
Yes, that's a good question. So once the loan has closed and funded, then the IRA is responsible for that monthly mortgage payment. So Next Generation would be mailing the checks on a monthly basis with authorization from the IRA account holder, obviously, for the amount that's due. And again, it's going to include your principal, interest, and then escrows for taxes and insurance paid to North American Savings Bank, and that will continue until, for the life of the loan until it's paid off.
And do you offer maybe refinancing of that loan? I know that you said you don't sell it on the open market. Is there an ability to refinance with you guys or no?
It depends on the situation. Occasionally we'll have someone that is looking for some cash out. And, they might have purchased a property 3 or 4 years ago and they want an extra $100,000 out, and we would do that. Rates right now are low. Our non-recourse rates are extremely low, so there hasn't been a large, really an opportunity for many investors where they'd want to refinance it to a lower rate. So we don't see a lot of that, I guess, just because of that aspect.
Okay. And when you mentioned the cash out refinance, I wasn't
Mm-hmm.
aware of that. I found that very interesting. And, I know a lot of people would be interested in that as well, especially if they use their IRA cash to purchase a property and then they were looking somewhere down the road to cash out refinance. That's huge.
Yeah, it's a real benefit to someone that they may have all their funds tied up in one home, and they just can't pull the trigger on another one because they don't know how they can tap into that equity. But this is an opportunity for them to do that.
Yeah, that's really great.
Mhm.
Does anybody else have any questions beside me? I don't see any other questions, Matt.
Okay.
Um,
Well, again, if anyone does have further questions after the presentation, or you may be listening to this on a recorded session, feel free to call us on the number listed, or visit our website, or reach out to Next Generation, and we can definitely work through those questions or concerns.
yeah, I wanna thank you for taking the time out, Matt, to give this presentation. I think it was huge. A lot of people have questions on it, so I think this is great education for our clients and potential clients.
Well, thank you for having me on, Jamie. I really appreciate it. And again, it's been great speaking to your audience, and thank you again.
All right, take care, Matt.
Thanks, Jamie. Bye.